The five biggest mistakes the stock market investors make in the stock market. That's what I'm going to discuss in this video because I believe most of us as investors, we go through the same journey. We all start in the same place and we make mistakes. We lose some money. We learn the hard way. After a few years, you start making good returns and then people will call you lucky. They will call you fake. They will call you all these things, but they don't really pay attention of all the mistakes that you made before that led you to have such great returns. And that's what I personally experienced. That's what a lot of different investors experience. We're not born perfect. We're not born where we just buy stocks and everything goes well most of the time. It doesn't happen this way, especially when you're getting started. So I'm going to take this video and talk about these mistakes, mainly for beginners, but I see them all over the internet, mainly because I get comments around the subject, and I really hope this is going to be helpful. And I've been doing more of that stuff, like I did this one, and it was a controversial one because I said don't DCA, and a lot of people misunderstood. And then I got another one which says when to sell a stock. It's only got 3,000 views, so I'm not really doing this for the views. I'm doing it for you guys because you enjoy them. And if you're wondering about, my returns and all that stuff, I have two videos on YouTube actually. One at the end of every year. I started in 2022. I did this one. It says my best and worst trades for 2022. You could go look at it. You could look at my performance. I was up 28% in 2022. And I linked to the videos where I talked about what I was doing, which was Occidental Petroleum and many different things. Then I did one in 2023 and I talked about all the stocks. I linked to the videos. It's all on YouTube. And then this year in 2024, as of now, I think it's 51 or 52%. The market has gone down, so I can put up the screenshot. I'm going to do it this year again. So it's all on YouTube. Everything is, public. I share what I really do in my group if you're interested. But everything here is on the public, and I hope you enjoy it. Now, the first one, which is the most common one, and it's not just beginners. Some investors have been in the market for 10 years, and they keep making this mistake. And it's crazy. It drives me crazy. And I get so many comments on it, and it causes people to lose a lot of money. And this is the market and the economy. The market isn't the economy, and the economy isn't the market. If people believe we're going to have a recession, the stock market doesn't have to crash. This is, I've seen it all over. People believe that a recession means we're going to have a crash, and this is not true. The first reason why it's not true is because we don't really know what defines a recession. It could be the 10-year and the 2-year turning positive, maybe. Some people say it's 2 consecutive GDP. We had it in 2022, and you could say 2022 was a recession based on the 2 consecutive GDP, but no one labeled it as a recession, or it could be unemployment, it could be something else. And every year or two, we have talks about why we're going to have a recession because of some indicator which is different from the other indicator. And the first thing is, no one really knows what quantify a recession until after it happens and the government decides to quantify it, maybe to justify certain government spending. So we don't really know what quantify a recession. This is subjective. And the second and the best example that I can give you is with a stock called Visa. Visa is a stock that I own, and I talked about it many times, and it's recently been doing well. And when Visa was sitting around 156, 157, I was talking about it. It was very undervalued in terms of metrics. But a lot of people told me, I am not buying Visa because we're going to have a recession and consumer spending is declining. Okay, and since then, Visa has done well. I just have to say. But I'm going to tell you something. Now, 2022, we might have had a recession. We had a decrease in consumer spending. And a lot of retailers suffered in 2022, and the market went down. Visa was only down 4%. In 2021, we had an expansion in liquidity. We had the stimulus checks from 2021. We had an amazing increase in consumer spending. Everyone was traveling. Everyone was spending on their Visa cards. So if you saw that I'm buying Visa because consumer spending is increasing and Visa has to do well, Visa actually declined 1%. Why? Because Visa was overvalued back then. Now the multiple has contracted. It has normalized. Now Visa is fairly valued again. So it's not much about the economy. You could have the best economy ever and Visa going down. But you could have the worst recession ever and Visa doing amazingly well. So you shouldn't base your buys based on what the economy is going to do. You have to look at what's priced in the stock. I mean, we might have a recession, but if the stock is down 30% and is trading the cheapest it has ever been, then maybe the recession is priced in the company and the stock's going to do amazingly well. So if you're trying to link the market and the recession or the economy together, you're making a big mistake and you're going to lose much more than you're going to make. And that's just the truth. I mean, I've done it. I lost money doing it this way. That's how I learned. All that stuff I learned the hard way, and I'm trying to share them with you guys. But the market is in the economy and the economy is in the market. Okay. The second one, which is an important one, and that's something I used to do. And it's called looking for an easy answer, meaning whenever we're getting started, we're a little bit lazy. We want something that just tells us something that's easy. Yield curve goes positive, mean we're going to have a crash. If a company is growing, let's say 2%, it means it deserves a multiple of 6 times earnings. If the company is growing 10%, it means it deserves a multiple of 10 times earnings. And we start, putting in those labels, especially between growth and multiple. Why? Because we're looking for an easy answer. And this is a comment I got under my video of Ulta Beauty. And I said, Ulta Beauty, why it's fairly valued at 15 times earnings. And I have nothing against this person, but I'm just highlighting an example that I get a lot of comments around, such subjects. And it says, Ben Graham says that companies that don't grow deserve an 8.5 time multiple. What makes you believe Ulta deserves 15 times? And this comment got 8 likes and 5 people saved it. Why? Because it's an easy answer. It tells us something. So when we look at a stock, we say, oh, the stock isn't growing. So 8.5 times, it's now trading at 10 times. That means the stock has to decline, 20 or 25% to get to 8.5. It's very simple. It makes it simple. But investing isn't simple. It isn't so easy. If it was easy, everyone would be Warren Buffett. Everyone would be, Howard Marks. Everyone would be those legendary investors. The reason why we know about all these guys and most if hedge fund managers underperform the index is because investing is hard and there's no easy answers. So my answer to him was that 8.5 times for no growth sounds good. But what if the company has 50% net income margin and the other one has 5%? Doesn't the one that has 50% net income margin deserve a higher multiple than the one that's at 5%? If one company has no debt, doesn't it deserve a higher multiple than the company that has some debt? If a company has amazing management, doesn't it deserve a better multiple than the company that has, very bad management or terrible management? And the answer is yes. So just because the company isn't growing, it should trade at 8.5 times without taking nothing else into consideration is a recipe for losing massive amounts of money and missing on massive upside on so many different stocks. And this is because, as I said, investing isn't easy. So the question is, how do you find the exact value of a stock? And the truth is you can't. It's all speculative. It's all trying to put the odds on our side. It's all about possibilities. We do our best to value stocks and do the best we can. But there's no special DCF or special formula that's going to give us the exact value of a stock because it could change week by week on many different things from the fundamentals. Maybe the CEO leaves. How could you include it? Even if you have the highest margin of safety ever, it's all speculation. That's the truth. We're all speculating, but we're trying to do our best to put the odds on our side and take a safety approach. This is the best thing you could do. So there's no easy answers and it's hard and investing isn't easy. If it was easy, then, everyone would be the next Warren Buffett. That's all I could say. The third one, which is a very important one, and it kind of correlates with the second one, and this is something that I see all the time from new investors, especially people that join my group, which is what we mainly do, is much more than value stocks. And people tell me, can you teach me how to value stocks? I mean, valuing stocks is easy, but what do you do after? How much do you add after? What do you do with position sizing? When do you get in? When do you sell it? When do you move to something else? What happens when the stock goes down? What do you do about it? And we do all that stuff in real time. And that's how a lot of people learn much better than just reading books. And, it's like an apprenticeship. So it's pretty good. But this one, seeking perfection, and it's mainly investors telling me, that let's say they bought a stock. They say, I'm kicking myself because I bought the stock yesterday and today it's down 3%. This is something I see all the time. Or, oh my God, I should have bought more. The stock is up 10% and I only bought a little bit. I should have bought more and I didn't. And they start swearing and they start getting upset and getting emotional and doing all these things. And this is a massive, massive mistake. And it's something I tweeted a while back. I believe it was in early 2024. I said, the stock market is up. People say, I wish I bought more. When the stock market is down, they say, I wish I sold earlier. The truth is you're never going to get it perfect. Discipline wins in the long term. You're never going to get it perfect. You're never going to have a 100% hit rate. That's something else that a lot of investors have, is they're scared of losing money. I don't know what it is, but I talked about it in another one. And I said, if you're scared of losing money, you're going to lose money, because the market isn't about not losing money. It's about making more than you lose. Because all these investors, Buffett, he lost money on airlines. He lost money on Paramount. He lost money, I believe, on Alibaba, which was a Munger investment, I think it was. No, it was Munger, it wasn't Buffett. But then you had, people like Stanley Druckenmiller. He went long big tech in 1999, all the internet stocks, and he lost billions and billions of dollars. You have many different investors that just lost money sometimes. I mean, it happens. You're never going to get it perfect. So you have to stop trying to be perfect, and you have to know that every time you're entering a position, you have the potential of losing money, and it's just part of the game. You learn and you move on, and that's how it is. The fourth one, which is a controversial one, a lot of you might disagree, which is buy and hold forever with every stock. And this is, I believe, a misunderstanding from a lot of investors. And it's mainly because Warren Buffett said our favorite holding period is forever. And this is something else I tweeted on Twitter. In a 2010 study of how markets react to Berkshire's trade, researchers found that 230 different stocks the company owned between 1980 and 2006, it held 60% of them for less than a year. 60% of Buffett's holding from 1980 to 2006 were held less than a year. Now, what happened to buy and hold forever? And this is where the misunderstanding happens. Is, in my personal opinion, not every stock deserves to be held forever. I believe in the market, there's two kinds of investments. The first one is a buy and hold forever investment, which is very long-term investment. You could say it's a quality company like Visa, like MasterCard, like Amazon, like Microsoft, like these kind of amazing companies, Apple. Those are amazing buy and hold forever. But the other kind of investment, which is more of a turnaround, meaning it's a company that's misunderstood, it's not growing, it has no growth, kind of like WBD, kind of like MPW, kind of like a stock that I had, which was a Geo Group, and I could use it as an example. I bought the stock last year around $7.10. I sold it this year around $14.50. I made like 100%, 98% on it in like 10 or 11 months. And I believe the company is still undervalued, but it's fairly valued, and it's not growing. Now, this is a company with a lot of debt and it's not growing. It has no growth. Do I really want to hold it forever? The truth is no. Why? Because the thesis has already played out. The market has changed its mind. Mr. Market realized it's a mistake and it got better priced in. So why would I be holding a stock with no growth, no good management, none of that stuff forever? It doesn't make sense. So that's how you have to think about that stuff. Not every stock is a buy and hold forever. For example, when I used to talk about Pepsi, people told me, Pepsi is the next 20 years, it's not going to be growing much in 20 years. I don't have to hold it for 20 years. I could believe Pepsi is undervalued. And if I see 8% EPS growth for the next 2 years, maybe I hold it for 2 years if Pepsi is undervalued right now. So I don't have to hold every stock for the next 10 to 20 years. And Buffett himself, 60% of his stocks, he sold them in less than a year. And this is something that no one talks about on YouTube because it doesn't fit a certain narrative of, buy and hold forever. And that's all I want to say. I know a lot of you are going to disagree, but that's what I have in mind. And the last one, which is also a controversial one, and is cloning other investors without doing research. It's obvious, but I also get a lot of comments, people saying Buffett bought the stock, so I'm going to buy it too. Buffett bought Paramount, so I'm going to buy Paramount. You're like down 50% right now. Or maybe something else. Because, it's just tempting because they know more than we do. So we want to copy them. But it's important to do research because in the market you can't really borrow conviction. And it sounds amazing when you buy a stock that Buffett bought and the stock goes up. But if it's down 20%, you're not going to have conviction to add more. You're going to be waiting for Buffett's 13F to come out, which is like 2 or 3 months late. And maybe Buffett sold the stock. Then what are you going to do? So you can't really borrow conviction. You have to do your own research. And then you could clone certain investors, but you have to know why they bought the stock. That's why I do these videos. I say why Michael Burry bought whatever, why Monish Pabrai bought the auto stocks, why Buffett bought Ulta Beauty, because I try to give you some research so you don't copy those investors. And when time comes to average down, you need your own conviction, and you cannot borrow conviction in the market. And that's all I can say. It's what I have for this video. If you want to learn more, you want hands-on kind of training, hands-on experience, you could join my group. We do options, we buy and sell stocks, many different things. So thank you again for watching. Not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.